All good. So this is joint work with my two PhD students, Luyang Chen and Jason Zhu, both from Stanford. So here we want to study the fundamental question of asset pricing. Why do we have different expected returns for different assets? We know the solution to this question is exposure to risk. And in a no arbitrage framework, we can model the exposure to risk with a stochastic discount factor or pricing kernel. Now the big question is now, what is a stochastic discount factor? And that is a challenging problem for a number of reasons. So first of all, the SDF should depend on all available information. So it's a big data problem in the sense that there could be a lot of variables that we need to consider. Number two, there's no reason why the SDF should be a simple, let's say, linear function of these variables. So probably we need to consider complex functional forms. And number three, dynamics should matter. For example, during times of booms or recessions, we could expect that exposure to an SDF or the risk premium can be different. Now, machine learning method might be a promising way to deal with these challenges. And if I talk about machine learning, what I mean are methods that can fit a general functional form, so they are non-parametric, and they can deal with a large number of variables because they have some kind of regularization. Now, the issue with financial data is that it's different from other domains where machine learning is very successful. Namely, we have a low signal-to-noise ratio with financial data. If you consider, for example, individual stock returns, depending on the method and the data set, is only around 1% of the stock returns that's predictable, and that is the risk premium part that we want to learn. Now, the innovation of this paper is that we are using no arbitrage constraints and combine them with the flexibility of machine learning to deal with the low signal-to-noise ratio, but at the same time being able to fit the right functional form. Now, before I go into the model, I want to highlight three conceptual challenges that we have in asset pricing and how we deal with them. So first, we want to learn what the SDF is. And we are all aware that some popular models are factor models. For example, the FarmerFrench 5-factor model would assume that the SDF is a linear model. It depends on 4 characteristics: size, volume, profitability, and investment. But what we are going to do is we will consider a very general functional form and hundreds of possible characteristics and other variables. Now, the second point, and that's a very important point, I feel it has not received the attention in the literature that it deserves, has to do with test assets. If I want to distinguish if an asset pricing model is good or bad, it depends crucially on the test assets that I'm going to use. Also, certain parameters of my SDF I learn from the test assets. Now, an example of very popular test assets are the 25 FarmerFrench portfolios, double sorted on size and value. Now, if I have an asset pricing model that can explain these assets well, it doesn't mean it will work well on other test assets. Now, here we want to push the idea that you need to use all individual stock returns and any possible portfolio that you can form based on these stock returns as the test assets in order to learn the features of the SDF. The third point is about dynamics. So it makes sense that during booms and recessions we have different exposure to risk. So in general, macroeconomic dynamics should be taken into consideration. One simple way to do it would be to use NBR recession indicators. Now, obviously, that's a very crude way to deal with the issue because we have hundreds of macroeconomic time series and the economy is more complicated. Now, what we are going to propose here is a new way to extract from a very large number of macroeconomic time series a small number of economic states, and exactly those states that are the most relevant when it comes to asset pricing. So what is this paper? So the title says deep learning, and deep learning is a machine learning technique that is very good at fitting general functional forms and dealing with many variables. And that's what we are going to use, but we are not going to use one deep neural network, but several ones, each for a specific task. So we have one neural network that gives us the SDF as a function of firm characteristics and macroeconomic states. We have another neural network that is finding the macroeconomic states from a large set of macroeconomic time series. And we have a third neural network that is generating our test assets. It will find the test assets that have the most pricing information that we then need to learn about the SDF. And all of these three different neural networks are glued together by a no arbitrage model. So there's an economic constraint coming in, putting these insights together. Now, empirically, our model works really well out of sample. So I will consider 3 benchmark criteria. First, we know that an SDF should be mean variance efficient, so I will look at the Sharpe ratio out of sample of our model and other benchmark models. We get an annual Sharpe ratio of 2.6, which is higher than the other models, so that seems to work. Second, I look at how well I can explain individual stock returns. We explain 8% of the variation in individual stock returns, which is twice as large as comparable benchmark models. Last but not least, I'm looking at standard test assets. These are sorted portfolios. We have hundreds of sorted portfolios, and in all of them we get cross-sectional R-squares larger than 90%. So it seems to work. Now, we can actually learn about the economic intuition, what is behind the SDF. So what was surprising to me is that the SDF seems to be almost linear if I look at characteristic in isolation. So there's a reason why factor models seem to work so well. But if I consider interaction terms, that is where the nonlinearity appears. Putting it simple, small value stocks have a different exposure to the SDF than small stocks or value stocks. And it's exactly this kind of nonlinear interaction that we can explain very well, and that makes our model better than, for example, linear factor models. We show that it matters to take economic states into account. And we can also confirm what are the characteristics that play a role in the SDF. And we show that all the classical anomalies in some way are necessary to model a good SDF. So if there's one message that you should take away from today, it is that economic constraints matter when you want to do machine learning. So if I take a simple linear factor model with economic constraints, it can work better than if I take an off-the-shelf algorithm, like a neural network, that does not include any economic insights. But if you combine both, the no arbitrage constraint and the flexible model, you can do the best. Now let me just quickly give you a glance of how this fits into the larger literature. So machine learning methods have become very popular recently, and there's one part of the literature, and the most important paper here is Brian's paper on forecasting returns, that uses machine learning methods to forecast returns given characteristics and economic time series information. And the main takeaway from this literature is that neural networks, which are very flexible, can work better than more restrictive models like linear models. There's another part of the literature that typically works with more restrictive models like linear models, but is also inferring the SDF from a large data set. The key insight from this literature is that economic constraints matter. So typically there's some form of no arbitrage that is used to extract more information from the data. Now what I'm going to do today is I'm kind of combining these two literatures, so I'm using economic constraints and full model flexibility. So Brian has already shown in his autoencoder paper that there is a benefit from doing exactly this. Now we are building on this and improving it even further. Now there are two very important points here, and we bring those to the table and no one has considered them before. And one is the construction of the test assets jointly with estimating the SDF. The other one is how to think about extracting economic states from the economic time series. And I will talk now in more detail about these aspects. So the model is starts with a standard fundamental no arbitrage condition. So look at the excess return of asset I at time t plus 1. I multiply by my stochastic discount factor m, then the conditional expected value should be equal to 0. Now it's important that I work here with conditional expectations, because what it means is that any variable that I can observe at time t, I can put it in here and I get an unconditional moment equation. So no arbitrage is just a large set of unconditional moment equations. Now without loss of generality, I can project my SDF on my return space. So I want to get the SDF portfolio. And in order to get this, I need to get the weights that each stock has in my SDF portfolio. Now, these SDF weights will be time varying because they will be function of the old information set, and this information set will change over time. So I will separate the information set into firm-specific variables like size, value, momentum, etc. And here I have a little sub-index I. And I will look at macroeconomic time series like unemployment rate, inflation rates, interest rates, etc. And we want to model the SDF weight of each stock as a function of this information set. Now, we all know that a no arbitrage condition can also be reformulated as a factor model. So without loss of generality, we can also consider a one-factor model where excess returns are explained by exposure, loadings to an SDF factor. But these loadings are time varying, right? They are general function of the whole information set. That's why they're varying over time. So what I want to estimate here in the data is the SDF weight. One, I have that I can get my SDF, I can get my SDF loading. Once I have my SDF loadings, I can run a cross-sectional regression at each point in time to get my residuals. Then I can use them to assess asset pricing models. So let's come to the estimation. So let's start with the assumption that I've picked some conditioning variable. In that case, I want to fit an SDF that minimizes my moment equation here. Now this moment equation can be interpreted as a pricing error. So I use a sample moment, so for each stock, I want to minimize the moment pricing error. Now, we will use a feed-forward, that's a deep neural network, to estimate the SDF that minimizes this moment problem. So it's like a GMM problem, actually. Now, the important part comes in here now. When I look at returns multiplied by a conditioning variable, this is actually a portfolio. So I give you an example. So one conditioning variable could be an indicator function, that is 1, if I look at stocks with small market capitalization and 0 otherwise. In that case, I'm looking here at the returns of small cap stocks, and I'm trying to find an SDF that can price small cap stocks. So finding conditioning variables is the same as finding instruments in the econometrics literature, or if you look at it from a finance perspective, it's the same as choosing test assets in order to estimate an SDF. Now the important question is now, how should we choose our test assets? What we are proposing here, and that's a novel idea, is a so-called GAIN, generative adversarial network. We will actually have two networks that are going to play a zero-sum game. Given test assets, I have one network that fits an SDF that minimizes pricing errors. Given this SDF, I have another network, my adversarial or conditioning network, that's trying to find test assets that I cannot explain well. And now these two will iterate. So this way I should find, so I'm going to control the largest possible pricing error, and I should find any test asset that has valuable information that I can use to get a better SDF. So that is intuition, right? We want to get the test assets with the most pricing information. Now if you think of this problem as an econometrician, you say, well, that's a GMM problem, and you're trying to pick optimal instruments. You probably have seen that before. Usually the GMM argument is based on efficiency. However, none of that is going to work here in a setup where we have a very large data set. All of these results break down. There is a subtle but also important point. If you look, for example, at a paper by Nagel and Singleton that also picks optimal test assets based on GMM arguments, the starting point is always that you have a set of test assets that is identifying all the parameters of the SDF. And then you pick those that give you the most efficient estimator. In reality, I don't think that we know what are the right test assets that give us all necessary information. So our approach is based on robustness. So we are controlling the worst possible pricing error. That's going to work with a very large data set. It's actually built for working with large data sets. And I argue that what we are going to find are test assets that are identifying all parameters of the SDF. All right, are we done yet? Well, not yet. So we still need to deal with dynamics. So here I'm showing you standard macroeconomic time series, unemployment rate, S&P 500 price, oil price. Can we use this in any kind of statistical approach? Of course not, they are non-stationary. So what do? We take increments. Let's say we take log price increments for S&P 500 price, so we get the returns of the S&P 500. Now if you look at all the paper I'm aware of in this whole literature, they're just feeding in the last period S&P 500 return into whatever algorithm that they have and try to use it to learn about the data. We cannot learn about the dynamics of the economy by just using the last period return. We would need to feed in the whole time series, and then we need to extract some kind of dynamic pattern. That's exactly what we are trying to do here, right? So we know that we need to transform macroeconomic data with some form of increments. Then we are using all these increments. We are going to infer a low-dimensional set of hidden states. The way we are going to use it is a so-called long short-term memory cell network. I'm very sure that all of you are using LSDM, even if you're not aware of it, because LSDM is used by Apple Siri, by Amazon's Alexa, by Android speech recognition. And so LSDMs belong to the most successful AI systems when it comes to speech data. Speech data is a time series, the same as time series I'm considering here. What LSDM are really good at, finding patterns where the dependency are over longer time horizons. That's exactly what I have to deal with when I look at a business cycle. So what an LSDM is going to do, I'm going to feed in 178 macroeconomic time series. It's going to give me a small number of economic states. On an intuitive level, you can think about I'm doing something like a PCA, and then I run a filter on it, like a Kalman filter. Then I use this as an input for all the other approaches that come next. So that would be a summary. So I have all my macroeconomic information. I extract a small number of economic states. I combine them with firm-specific characteristics. I get an SDF to price test assets. I have an adversarial network that's generating test assets that are not explained well. And now my SDF is going to learn to price the old and the new assets, and I'm going to iterate this approach. And that is what I will call my gain. So let's come to the empirical part. So we have 50 years of monthly stock returns, all stocks from CRISP, combined with a large number of firm characteristics, all the usual suspects, normalized into quantiles. 178 macroeconomic variables. I think all that have been studied in the literature are included here. So we have a very rich data set. And we will use 20 years to estimate our SDF. There are a number of hyperparameter or tuning parameters that we're going to pick on a validation data set. We have 25 years complete out of sample, no re-estimation. We're just evaluating our model. Now we will have two benchmark models that we want to compare it against. And one thing I want to highlight, there are of course a lot of machine learning methods out there, and we don't want to run a horse race who gets the highest Sharpe ratio. So we have picked these benchmark models because they're in some way special cases. So what happens if I take my complex model and say every functional relationship needs to be linear? In that case, our model boils down to a linear factor model where you do a mean variance optimization on long-short factors. Now, because we have a lot of long-short factors, it makes sense to use some kind of regularization, so we can put in an elastic net penalty. What we are going to end up with is essentially a version in the spirit of the Kozak-Nankel shrinking the cross-section paper SDF recovery. So the linear model, the special case, is essentially like a robust SDF based on linear factors. Now, what is the other extreme case? So if I take out any economic constraints, but I keep the full flexibility of the neural network, I end up with a forecasting approach. Here we are going to use the best forecasting model of Brian's paper, the machine learning forecasting paper. And note, once I can predict conditional mean returns, I know that those should be proportional to an SDF beta. So predicting means essentially gives me an asset pricing model, because once I have my SDF beta, I can use it to recover the SDF, look at pricing errors, etc. So that is here the benchmark. I want to learn what is more important, or how important are model flexibility versus economic constraints. So we'll look at these objects here. We estimate the SDF for each model. We get the beta, we get the residuals. Then we look at the out-of-sample Sharpe ratio. We look at the amount of unexplained variation. So we just square all these residuals, average over time in the cross-section. Or we average the residuals first over time, which gives us an alpha, and then we look at the cross-section R squared. So very standard, thank you, very standard benchmarks. Here are the results. I only focus on the test, which is the out-of-sample result. So our Sharpe ratio is monthly 0.75, which is much higher than the other benchmark models, almost twice as high. We explain more than twice the amount of variation in the data of individual stocks compared to the other models. We have 30% more cross-sectional R squared. So it seems to work well. Now, one thing you should note is that a linear factor model with economic constraints works as good or even better than a simple machine learning model with no economic constraints. So do economic states matter? Well, probably yes, otherwise I wouldn't spend so much time on them. But here I can show you how much they matter. So just focus on the left part. These are the out-of-sample results for Sharpe ratios. Top part is the benchmark model that I'm estimating. And now I'm looking at what happens if I just feed in, of all my macroeconomic variables, the standard canonical transformation, like S&P returns would be an example. So just feed those in, and keep in mind that's what, to the best of my knowledge, all other papers are doing. These models are going to collapse because you feed in information that doesn't really have economic content. You just have a lot of unnecessary variables. Now, if you keep the macroeconomic information out completely, you will do actually better. But now, this gain that we get to the top, this 10% increase, that is what we get if we infer the economic states in the right way. Now, once I have an SDF beta, it should predict future returns. High beta should be high future returns, low beta, low future returns. So what I'm going to do is I'm going to sort all my stocks into deciles based on past periods betas. And here is where my out of sample period starts. And this is the highest beta decile portfolio. It has the highest future return. This is the lowest beta portfolio with the lowest future return. In the middle, we get a perfect ordering. So betas predict future returns. But this paper is about asset pricing, so let's go back to standard test assets. Here I'm looking at value-weighted, characteristic sorted deciles. I start with short-term reversal sorted portfolios. The main point is that our gain model is almost twice as good compared to a simple forecasting model or a linear model. When it comes to explaining variation, it's also much better when it comes to the cross-section R squared, almost twice as high. So it works for this specific cross-section, but I didn't cherry pick it. I have 46 characteristics. For each of them, I can get 10 decile portfolios, and I can repeat this pricing exercise. And with no exception, for all cross-sections, we get explained variation that's higher than the benchmark models, and we get for all of these cross-section, a cross-section R squared of 90%, which again is much higher than you've seen from any other model. I can illustrate what I've shown you in numbers with a plot where I look here at the expected return for all the 460 decile portfolios and the model implied expected return. On a 45-degree line, we would have a perfect fit. It's not perfect, but it gets the monotonicity right. If you look at a simple forecasting approach or the linear models, it's definitely worse. And there are a lot of more outlier portfolios. All right, so we have established this model can help us with asset pricing, but what do we learn economically? What is this SDF? Now for each model I get an SDF time series, so a starting point could be to look at correlations. So I can look at the correlation of my SDF with a market portfolio, which is close to zero, with a forecasting approach, very low. So the highest correlation we would get with a linear special case of our model. Now you can take your favorite factor model and see, can we use these factors to explain our SDF? I start here with the FarmerFrench 5-factor model. The main takeaway is that we get a highly significant alpha, but the FarmerFrench 5-factor model is not going to span our SDF. So what information do we need to span it? Well, we can look at what are the variables that are important in our SDF. Now, we have a nonlinear model, so it's a little bit harder to talk about which variable is important. If I had a linear model, I could look at the slope coefficient. Higher slope should imply, after some normalization, a higher importance. So what I'm using here is the so-called average absolute gradient, which is a generalization of a slope. Higher absolute average gradient means a characteristic has a higher impact on my SDF weight. And I will sort all characteristics that I have into 6 categories: trading frictions, value, intangible, profitability, investment, past returns. And the main takeaway from this slide is that among the first 15 important variables, each of these categories is represented. So all the classical anomaly categories somehow need to be included in our SDF. And that is not, I mean, this is a result that is, I just want to contrast this with what you would get if you look at the forecasting approach. So here, I'm using no economic constraint. If you look at the first 14 variables, you see that they're all in the categories past returns or trading frictions. And if you can dig deeper, you might ask a question, is a simple forecasting approach not just simply fitting small illiquid stocks? But our approach seems to be robust against this potential threat, and we argue that it's because we select test assets in an optimal way. If large cap stocks have important information, we would find those as test assets, and our SDF would adjust for that. That protects it against overfitting small cap stocks. What about the macroeconomic information? So our model implies there should be 4 economic state variables. And I'm showing you the time series here, and the gray areas are NBR recession periods. If you focus on the 3rd and 4th time series, you see that they seem to be cyclical, and they seem to spike or have a downward or upward spike right after recessions. So it seems that these macroeconomic state variables are related to economic activity, and that's what we hoped we would find. So last but not least, what is the functional form of the SDF? Now our SDF is a function of many variables. Now I can fix all variables but one at their median level, so I get a one-dimensional function, and I can plot it now. So I can look, how does my SDF depend on size or book-to-market ratio? And what we find, and that was surprising for us, that these relationships are all monotonic and almost perfectly linear. So in isolation, our SDF looks almost like a linear factor model. But what happens if I look at interactions? When I mean interactions, now I'm looking at the effect of size among value stocks, that would be the purple line here, and growth stocks, that would be the blue line. Different lines represent different value quantiles. What you see is you get highly nonlinear patterns, you get interaction effects. The same if you look at the effect of value among small cap stocks or large cap stocks. These type of interaction effects you cannot get with a linear model. You cannot get them with models that use kernels or splines, like other papers in the literature. We think that this is really the economic takeaway here that we find empirically. Instead of just giving you these 5 slices, I can show you the completely two-dimensional function of the SDF in terms of size and value. And the monotonicity pattern is how you would expect it, what is low and what is high. But there are non-trivial complex interaction effects going on, and that's exactly what we can capture in the data. We can go to interaction of 3 characteristics, we find even more complex patterns. And we think that is what makes a difference compared to a linear model. Before I'm going to conclude, I just want to highlight we've done tons of robustness tests. So our results are robust to market capitalization, so it's not driven by small cap stocks. It doesn't depend on the tuning parameters that we have. So in a revision of the paper, we include models with a lot of more tuning parameters. The results are essentially the same. So we really get some structure that is not sensitive to tuning parameters. And it's also stable relative to the time period that we've picked. So you can change the time period to get the same results. So we believe we find some real economic structure, and it's not some overfitting or driven by certain choices that we have made. I think I'm running out of time, so I'm going to conclude now. So today I've presented a machine learning approach to recovering an SDF. And there are 3 takeaways that you should have. One is we use an economic constraint. Some other people have done this too, but we do it in a somewhat different way. And we deal with the issue of how to find test assets, and we propose a very novel conceptual idea to think about that problem. And compared to other papers, we also deal very differently how we extract dynamics from time series. Overall, this gives us an asset pricing model that's very general and that seems to perform very well out of sample when it comes to pricing. If you learn about the economic structure, linearities hold in approximation if you look at only one characteristic, but once you look at several characteristics, it's the interactions that you need to take into account. And overall, our model seems to work quite well in a number of dimensions. And if you care mainly about investment, well, you also get a highly profitable investment opportunity out of this output that we have. I'm going to conclude now and look forward to Brian.